Ladies and gentlemen of the crypto space, we're live on a Monday, March 20th at 11:39 a.m. We started this stream a couple of years ago talking about cryptocurrencies. Currencies are made by sovereigns, currencies are made by banks. I think that's something we've talked about. And if not, we should really hit home that the vast majority of currency in circulation is bank money. Then that's using the bank's infrastructure, the banking system, and the way their books look when they create a credit, when they extend credit. They're able to add a liability and they're able to add an asset to their books. Their balance sheet expands. They now have more money. They created it out of nothing. And as many folks discuss, there's way more of these types of currency units in circulation than actual paper dollars. So the entire system really is that system. For instance, you log into your Chase account, you see a number on a screen. Those aren't dollars, those are bank dollars, bank money, bank liabilities, bank credits. The bank owes you a dollar. Now, clearly, you can go to an ATM and withdraw paper money, in which case, that is probably what the bank doesn't want nowadays. The bank really wants you to use a credit card because then it could just transfer the liabilities that it owes you to another account that happens to be open with it. Like American Express has an account with Chase, and if I pay an American Express bill using the credits that are in my bank account, Chase is transferring those credits from my account to the American Express account, in which case they never had to figure out where the hell they're going to get the paper dollar bills from. So, in good part, the size of the global economy makes it very difficult to acquire paper dollars at times. And then you have what is obviously aptly termed a dollar shortage. Right now, we could see in the data that it's not a dollar shortage. We had a dollar shortage. And let's pop it over to the main screen so I can do both at the same time and show you where we are. So clearly, for all of 22 and half of 21, the world was scrambling for dollars, and they were purchasing them from forex markets. And that equation changed in October of 22, where they found another source of dollars. Because is it the case that for some reason the system doesn't need dollars? And clearly, consumer price inflation has a capacity to curtail demand. And if there's less demand, less financial activity, there's less need for dollars. But there's also things that we've talked about over the last months, alternative sources of dollars, because you don't necessarily need paper dollars. You could take a piece of collateral, you give it to a bank outside of the US, and the bank issues you a loan. So you deposit this collateral with the bank as, a down payment or collateral or deposit or whatever terminology makes it easiest to understand. $100 worth of collateral, and the bank gives you X amount of dollar liabilities in an account. And the relationship, the contract, the terms of that agreement, you can imagine vary the entire spectrum of potential variations. But let's say they give you $95. Maybe let's say they give you $99.50. We've talked about reasons why you issue $100 worth of collateral. And what is the worth of collateral? Is it the face value or is it the market value? And under what conditions? Maybe it gets complicated. But point being, the liabilities have a capacity to service obligations, especially when those liabilities or servicing obligations are serviceable at the same bank, so you could just transfer liabilities between the banks, or within a network of banks where these dollar liabilities can be transferred to. So there's plenty of reasons why the pressure came off the dollar. So what do we know? We know the system operates in cycles. We know that we had a dollar scarcity situation for 1.5 years, which clearly topped, and we see it very clearly in the chart. And we find ourselves in a very different situation right now. Right now, it's not dollar scarcity. There's the upward pressure is gone. Uh, we saw a little bit of support around the TWAP, but it's falling through. And, you know, this is a weekly chart. I don't look at the weekly charts anymore. I'm inclined to think this will continue trending down. And then if you go out to stuff like the 6-month chart, you see bigger trends. And you guys know that I've taken the price action chart off and you look at the TWAP, and cyclically, this is what happens over months. And the U.S. needs to devalue the currency in order to maintain the status quo, and that's Luke Groman's wheelhouse. We're likely to see a large devaluation, and how that plays into consumer price inflation is knock-on effects. So where are we right now? Right now, there's a couple of things going on. And there's also a broader context of why what's going on is going on. There's distortions in the system. And the distortions are a manifestation of, well, dollar scarcity. Dollar scarcity causes all sorts of awkward behavior changes. If you have a $100,000 income and all of a sudden you have $75,000 income, and then the next year you have $50,000 income, does that dollar scarcity cause behavioral changes? You see, that's probably the most obvious and best way to understand a lot of this macroeconomic talk is to apply it to where you didn't think it was applicable. Dollar scarcity, collateral scarcity, put that in terms of your behavior. If you have less dollars than you want or need in order to do something, I mean, simply if you want a car and you don't have enough money, you're in a dollar scarcity situation. Now, clearly, it's different for when you need something, when an enterprise needs to purchase goods or services, then you get into an issue where the enterprise may not work anymore. But does that not occur for people as well? If you have a $500 monthly bill and you only have $400, oh shit, it's the same exact thing as a company not having enough money to pay its bills. Companies, people, everything reduces to the same phenomena over and over again. Assets, liabilities, debts, servicing obligations, cash availability, capacity to pay bills. And when there isn't enough currency units available, it causes all sorts of distortions. Now, at this point, I've been very Jeff Snyder pilled, and that's probably rare amongst folks that think about macro, and especially amongst just general personalities that are interested in crypto, especially, and folks on Twitter and social media interested in macroeconomics, because it's some deep shit. But to break it down very, very simply, total currency units in circulation, total dollars, is both paper, but that's marginal, that's small, compared to logging into your Chase account and seeing a number on the screen. That's the majority of money. And that amount of money hasn't been increasing at the same rate. In fact, it has decreased significantly. So you hear folks talk about M2, and it's only a small part of the big picture of what's going on. And M0 is microscopic. It's like 5 and change trillion US paper dollars that have ever been created. So the point being, if the amount of money isn't at the same exact trend rate of change, and it's going down significantly, that causes significant behavioral changes. All of a sudden, companies, businesses, countries, people, it's harder to find a currency, the money. There's less of it. So therefore, people do more for it. They work more for it, or they have to spend more in another currency to get it, or they have to give more of a commodity to get it. They have to buy it for more. It's scarcer, and it causes all sorts of wacky distortions. So in that regard, um, the behavioral changes we see in the banks having to take more risk, and what us as individuals have done over the last since 2008 to get our hands on more money because we are making less. Something feels broken in the system. We're not getting ahead. Consumer price inflation is putting pressure on us. There's less dollars that we have access to because there's less dollars available for wages to increase, which in turn increase supply. Uh, in a normal system, there's not, malinvestment. If people are buying more goods, they're going to want to make more. They're going to want to invest in their business because, oh, it's booming, it's healthy, there's a natural balance. And when there, and why would that business not increase production? And why has everything changed since '08? It's because of fear. When you have the crisis that occurred in '08, the fear, the kid shit in the pool. Big macro kid shit in the pool. That's where we're at in the story. So if total dollars isn't increasing as much as it used to pre '08 and it is leveled off and it's declining and up, and you can see that in obviously Jeff Snyder's charts, but a good place to see that in a chart that I could pull up really quick that's nicely representative of generally, I guess, stuff that he would show would be derivatives. So look at the rate of change of derivatives. Imagine this was cash for a second. The trend rate of change has broken since '08 and it never recovered. So we as individuals have less money, banks are issuing less credit, companies have access to less money, so they're not keeping up with the manufacturing. And now, to top it all off, we have peak globalization. Supply chains are all messed up. People and individuals and companies are now at the point where the distortions are just magnifying to the extremes and the behavior is changing. And that is why the entire cryptocurrency space manifested into what it is. People are seeking to outperform. Outperform what? Outperform their job, outperform whatever historic investments they've had because, equities aren't doing the same or doing what they wanted them to do. And bonds aren't doing what people wanted them to do to allow them to outperform. So the cryptocurrencies are offering a potential to outperform. Maybe look, real estate. Real estate historically allowed you could get into real estate easier. The prices were cheaper and and you could become a home flipper and you could rent and get income. It is harder to do that now. So what happens over time is the opportunities for outperformance are attacked by vultures because we're vultures, we're opportunists. We're going to see an opportunity, we're going to take it, and we're going to do with it what we can to achieve our goals. And over time, those opportunities have been consumed like a resource, and there's fewer and fewer opportunities pushing people out to take further risk. It explains all of our cryptocurrency behavior thus far. Because when currency, as you can see in the this particular chart, but if we're thinking in terms of global available currency, when there's less of it, look, there's plenty of times in history scattered with periods where banks created currencies under different structures than we currently have. So that's what we're doing in crypto. We're creating currencies. That's what countries do. They create their own currencies to try and and it's very difficult and try and manage the availability of currency for a particular group, a population. And obviously, the purpose of a currency is to organize labor, coordinate behavior, encourage and incentivize productivity. So there's certainly, we see these three things: incentives, incentivize labor, payment. We see all these behaviors changing around these concepts that we often overlook. We don't think about. They're just kind of expected behaviors that we do on a daily basis. But it's just fascinating how crypto really is a manifestation of malinvestment and lack of currency in traditional finance. Because if everyone had access to money by being productive and getting great wages, 30, 40, $50 an hour in today's value working at fast food, no one gives a shit about crypto. You have more than enough money to get a mortgage, have a car, buy all the food and groceries, pay for your kids' college. This is like the golden age everyone talked about in the 60s, white picket fence, and the husband went to work, the housewife stayed at home, and those old images we could conjure in our mind of a time when it was easier. Go to work, less pressure, but now we're under constant pressure because we don't have access to the dollars that we want and need, such that we have a stable capacity to fulfill our desires. We are experiencing dollar shortage as individuals. So that's that's where we are, very big picture. And obviously, we could digest what the hell's going on today, coming off last week's banking crisis, which just continues this week. Um, I don't know how much folks want me to digest what's going on literally today with the banks, but I can. I'm pretty sure. I'm going to hit the comments. Let's see what you guys. And bam, there you go. CryptoTube, you see the ECB statement with credit swaps, DXY down. So this means there's not a currency shortage right now. So the system operates in cycles: currency shortage and collateral shortage. Why? Because that's what the books are. And the books are a good old boys club. Everyone trusts everyone because everyone has books of double entry accounting, assets, liabilities, and everyone has copies of everyone's books. So everyone's books need to balance. Otherwise, someone says, I don't want to play with you. Your books are wrong. And that's literally what happened to Credit Suisse. And it gets complicated when the books don't balance and you eventually see no path to balance the books. So the world is filled with broken books right now. And swap lines are the only thing the U.S. could currently do, and it's a defensive measure where if banks outside the U.S. where swap lines have been agreed upon need dollars to meet withdrawal demands, the banks don't need to sell their collateral on the books. Why is this meaningful? It's the same thing that happened in the US. The collateral on the books in foreign banks has gone down in price significantly. If they sell that collateral, they're going to realize a very, very big loss. They bought something at $10,000 and now it's worth $7,000, $6,500. They lost a shitload of money. And in some cases, when they sell, there isn't enough money to give to the person that asked for their money at the bank. And that's what happened the Friday before this past Friday. There was a $1 billion shortfall for demand obligations, withdrawal obligations. They didn't have $1 billion. Um, so the question, a good question is, at what value do the swap lines execute? The BTFP program that the FDIC announced offers dollar credit at face value. $100 bond gets $100 of credit, even if it's trading at $90, $95, or $70, whatever the hell it's trading at. So we don't know those details. That would be interesting to ascertain, but that is an issue unto itself. At least the swap line does allow them to borrow dollars against the collateral on their books without having to sell the collateral. They sell the collateral that increases interest rates, so their imbalanced books have a capacity to blow out of proportion, completely distort even further the U.S. bond market and international FX markets. One, if withdrawal requests force bank action, they have to sell collateral. Interest rates go up. Well, bond prices go down, interest rates go up. And there's now demand on dollars because the odds are the withdrawals are dollar denominated. So now they got to come up with dollars. So there goes the FX markets. So that's the point that I'm observing. This is the dollar. Let's put the price back on and let's go to a weekly. So we're not seeing a blowout to the upside. This is why they turned on the swap lines. The U.S. does not want to see dollar forex blow out to the upside. They want to offer an exhaust valve to relieve pressure. Now, there's a couple of problems which I noted on Twitter. This is a fun one. This may be a long stream today. There's a lot of content to talk about. Check this one out. So if it depends on the type of collateral the banks have internationally. Now, what have we been discussing lately? The banks obviously have U.S. collateral. It's a very popular collateral. Why? Because the United States swap lines will gladly accept U.S. collateral and lend against it. But what happens if they run out or they don't have U.S. collateral available? Because we've been discussing euro dollars. Euro dollars may be an unsecured line of credit, 0% down. The bank issues to a very trusted party $100 million. They've been business with them for 50 years. Here's $100 million, zero down. Why not? So the bank now has an asset on its books, the debt, and a liability, which is the amount in the account that the debtor can withdraw. So now the debtor has to service their debt obligation. The bank has an asset and it has a liability. It owes that money. Um, so that collateral, that debt obligation isn't a U.S. security. It's an unsecured line of credit. Clearly, U.S. swap lines are not going to accept that. So the point that needs to be driven home is that's probably the vast majority of collateral in the system. To what extent U.S. securities, U.S. bonds are rehypothecated X amount of times. Even if that's the case, you have way more liabilities outstanding than actual unleveraged, pristine collateral available. So the books are so incredibly imbalanced and likely not even collateralized by stuff that the swap lines will accept. So there's extraordinary potential for the tools that are available to not suppress volatility. Listen, we've been saying that a lot lately, that the entire exercise of everything that we're seeing is that to suppress volatility. What do you think the damn swap line is? To suppress volatility. BTFP, suppress volatility. They are suppressing the shit out of volatility at all costs. No holds barred, no dollar spared, because deflation is on the line. And this is the type of crisis that we saw in 2020, and obviously a couple of times to a lesser extent between 2008 and now, but obviously 2008 was the most recent large scale global potential deflationary event that takes down in a cascading fashion bank after bank, because the banks lend and borrow from one another, rehypothecating collateral left and right. And it's not even U.S. pristine collateral. It's conjured collateral out of nothingness. The books are cooked and they're shot. They've been taken out back and shot. So there's great reason for them to fear deflation more than inflation. But what is inflation? There's such confusion about it. And I remember a couple of years back trying to digest what the heck inflation was. And I remember realizing if you're talking about inflation, you have to talk about everything individually. Now, inflation of what? Currency? Inflation of my bank account? Inflation of the price of cereal at my supermarket? Inflation of my ass? If I eat too much, my ass inflates. So there's a lot of confusion. You ever get into a conversation with a friend or family or someone on social media and they say, "Oh, inflation." Anyone who says inflation without context, just stop. You're going to drive yourself nuts. Inflation means absolutely nothing unto itself. Inflation is an adverb. I believe that's the case. Not an adjective. It's not. I guess my ass can inflate, but that's yeah. You see where I'm heading with that train of thought? It's the it's something changing. So just keep that in mind when you hear that terminology. Athena made it live, a pleasure. One curious few. Good morning, Alexander. Hey, hey. Looks like the money printer got turned on this weekend with statements from central banks. No, it didn't. The only I don't even know if 2020 they printed money. You know, I don't want to get too abstract. What is money printing? But bear in mind that's a big philosophical question, and this is something that Jeff Snyder always talks about. What the fuck is money, or what is money in our current system? Because yes, paper bills, that's money, but we don't use paper bills. The majority of people don't use paper money, so they're not using money. Is not paper money money? Paper money is money, but what is not paper money? It's not the same as paper money. So it gets very, very philosophical, and then so I don't want to digress too far into the philosophy of that, but it looks like the money printers. Let's dig into this. So swap lines is what they've historically done to deal with collateral shortage. If the books are imbalanced and the U.S. fears international banks will have to sell their collateral and realize losses, which would drive the DXY to infinity and beyond, they set up the swap lines to offer banks a capacity to not sell their collateral, not realize the losses, and not drive the DXY to infinity and beyond. So there's the scenario I just discussed where swap lines are ineffective. They do nothing. It's not a collateral that the swap line will accept. Um, there's a variety of ways this plays out where the tools that currently exist don't work. And that's probably a sort of situation that the U.S. found itself in 2020, where we started to see exotic shit play out, and they started to airdrop money directly to people, and that's a big issue with swap lines. How do you get the U.S. government is not in a business of giving money to John's Pizza Shop in Main Street, UK. So, there's a whole lot of moral hazard to think about with how it plays out. But I think a good point to make is they're past the point of no return with regard to they're going to fucking do whatever they got to do to keep the status quo. Because you got to remember, this is about optics, this is about elections, this is about politics, this is about the Fed actually having credibility that they have a job for a reason. They have control over anything, and I appreciate maybe more so now than ever as I understand more and more the points plural that Jeff Snyder likes to hit home on. What do they do? What the fuck are they doing with their entire staff? Maybe managing the facilities that they operate, but they're not in control. It's really questionable what they do if there's any significance to it, because what they're doing is so small compared to the size of the machine that really governs the pressures in the system that affect all these behaviors. It's so out of their control. So when crisis really hits in like 2020, it's sheer panic. It's freaking panic because there's no way to get dollars to some bank that's blowing up in a country that doesn't have swap lines. But if that bank blows up, it takes out half of the European Union because nobody knew that the European Union lent them $1 trillion. I don't fucking know. It could be something crazy like that. And all of a sudden, because if they lend $300 billion to some country turns out they can't repay it, that bank in Europe has a $300 billion piece of collateral on their books that they probably used and rehypothecated to lend out more liabilities to people in Europe, and all of a sudden that collateral goes boom, and now they have an imbalanced book, and then that bank go bye-bye, and that just cascades left and right. So that's the scary part of the euro dollar system. It could evaporate into nothingness, and the cascade would just clean sweep the banking system if it's big enough. Rip Credit Suisse, bondholders. So what? What was it? The equity holders got bailed out? That's crazy. I mean, that doesn't make any sense. 'Cause doesn't that some serious moral hazard? Doesn't that piss people off? Bonds are always before equities. Raul, a pleasure. Alexander, can the ECB statement be seen as Fed giving the ECB preferred access? Yeah, but they also did swap lines across the board to all the allies. So it's not just the ECB. Inject liquidity in the European banking system so the depots are not sold to the open market. Well, that's exactly why they have swap lines, is to prevent the U.S. pristine collateral from being sold on the open market that drives up rates and puts bid pressure on dollar forex. So you understand the causality, the sequence of events there. So swap lines unto itself are quite moral hazard, you know? So it's pretty crazy in that regard. Jesse, hey yo, caught the live stream. Awesome. Thank you, Noah, for your insights and thoughts. Mr. Rational keeps us in the game. There's no exiting the game. This is an experience. This is life. This is us navigating the system and engaging with a market that actually presents us with opportunity, because opportunities are like natural resources. Now, once natural resources get consumed, there's less of them. If you have locusts on a crop, it gets pillaged. So what do you think has happened to the U.S. equities markets? It's pillaged and perverted, and it's been harvested. There's nothing left. Fucking GameStop and AMC. Who gives a shit? Who wants to go into a field with 10,000 idiots to try and pull out some opportunity? What a waste of time. I think there's better opportunity for things that the majority do not understand and cannot understand, which is why I have spent so much time myself understanding these complicated systems and why I have not stopped presenting these complicated systems to folks as simply as I can, and why we always engage in the Q&A so that folks have a capacity to ask complicated questions, simple questions, so that we could actually get relevant information out there regarding complicated systems that are cryptocurrency related that most people don't understand granularly. I like to break it down. We talk about very complicated crypto systems in terms of macroeconomics, in terms of things that people understand, rent, and biological systems, predator-prey relationship. And we will keep trying this. We will keep trying to understand these things in terms that people can understand to do just a little bit better. One curious view, are you concerned about balancing giving losses from Euler hack? I am concerned about many things. The question in my mind reduces to, is there anything you can do about it? I nowadays find great peace of mind engaging with things that allow me to no, I can't do a fucking thing about it. What am I concerned about? It depreciates. Something I own depreciates. I expect several things I own to go to fucking zero. My mentality is if one of the things I own still exists in 5 to 10 years, it will have proved itself as a piece of systemic infrastructure. Now, the potential for that systemic infrastructure is monumental. The amount of dollars the system needs in order to regain any type of health is extraordinary. And you're not going to do that with paper money, and you're not going to do that with traditional banking system. That is the potential for the crypto markets, is a network that has a capacity to support capital and credit expansion to fill the void where the Eurodollar system has failed since 2008. Now, there's probably going to be some novel risk mitigation systems that are needed because that is why the Eurodollar system has failed for so many years, to allow the system to regain healthy growth, as banks don't want to take the risk. So we see this. What do you, in fact, it's quite incredible. The entire notion of over collateralized lending and just sadistic liquidation systems that liquidate you just like a sociopath. You're liquidated. So it's healthy, it's sustainable. The infrastructure protects itself, and it will lend unquestionably, instantaneously. It will lend to you if you collateralize your credit. So I think, I'm digressing a bit, but that tickles me pink. And as I said, as I will continue to say, the biggest thing in the crypto markets is the dollar liabilities. The potential is enormous once realized that the biggest pain point in current economics is lack of dollars. And it's and the system's responsibility to get those dollars to where they're needed. And there's no correlation between the amount of dollars in the system and direct correlation and consumer price inflation. That's such a shallow relationship that people see. What happens with the amount of dollars in the system is investment, and what you have right now is malinvestment. It's not because of ample dollars. It's because, frankly, of lack of dollars in many regards. If you think anything is absolutely the case, you probably need to question the thought process because almost everything you think you could argue both ways. Imagine that. The malinvestment in the system is caused by lack of dollars, and those lack of dollars force people to take more risk to get their hands on dollars. Think about that from a personal perspective. If I don't have enough money, I'm freaking out. And I'm probably going to do some shit to get my hands on money. Maybe I'll speculate. Maybe I'll gamble. Ah, lack of dollars forces increased risk taking. Oh man, that's a wild, obvious observation. So the system lacks dollars, and it has forced people to take behavioral engage in behavior that is not optimal for the health of the system. Huh. Anyway, that was a big one, Jesse. Good stuff. Good stuff. One curious view. Are you concerned about balancer? I nailed that one. Uh, Crypto, good morning. James, I know the kids shit in the pool, but I think the whole town just shit in the pool and the lifeguard is having egg sandwiches. Right about now, that is absolutely the case. Right about now, nothing is safe. The swap lines present a story to the general public, but right now, the contagion, it's an infection that's spreading, and that infection is part fear, part quantitative with balance sheet health, and there's a risk associated with that, and we have to wait and see how the fear potentially could push the health of the balance sheets of the banks past the critical threshold called solvency. We're at the solvency crisis that Raul historically talked about. And we have, he talked yesterday with Pomp, and that was a big one. If you didn't see Pomp's Raul interview, real estate, commercial real estate, and the change of societal behavior with regard to going to work. Oof, I get very emotional about some of this shit. Demographics, everything's changing, and they're going to have to respond. And the problem with traditional finance is it fucking sucks. It's slow as shit. So I'm curious what plays out with Fed now, because if you had Fed now and you want to pull your money out of a bank, you could do it 24/7. That kind of changes the equation a little bit. So there's a lot of stuff that's going to play out. I'm very interested. And, it's a separate conversation with regard to crypto investment. And maybe if you guys ask questions, we could try and tell a story how we correlate the entire story of today with how the hell is this guy comfortable with my investment portfolio. So it's an entire conversation. Um, Mick Mon's in the house, a pleasure. Tape pusher now. You have evolved. Afternoon, in your opinion, what is better as a simple CG? Uh, better. Outperformance. Complicated questions. I nowadays take the safer thing rather than outperformance. I've been thinking about like, Convex came out. So I've been thinking, I see the new stuff. Convex has their CVX FPIS now, and that's cranking out a couple 100%. It's like 300%. Yeah, wow. Yeah, but this is in CVX FXS and 13% FPIS. It's a wonderful number. Will it get diluted? Yes. And where was my thinking this morning? FPIS. With that kind of yield, this chart's going to go up. There's a nice capital gains opportunity here. So because that'll get diluted, and once that gets diluted, that means the position as a productive position will get diluted, and it no longer is, so it's a transitory opportunity in that regard as compared to other opportunities. Um, but that yield should offer sufficient incentive to encourage significant price appreciation in this asset. And now I'm like, do I want to sit around and engage in that behavior? Maybe get 100%, 200%. Maybe it does very well. Um, or do I sit back and remind myself that I don't need to do anything because there's plenty of other interesting opportunities that will return less, but I have less to think about. I don't have a position to sell. I don't have to worry about volatility. I don't have to think about all the risk associated with a volatile position. Albeit there's always risks. Oh, I wish I could show IPOR, but I can't do it without VPN on. That's annoying. So this thing's cranking out some nice returns on stable coins. In that regard, there is risk associated with its chart, so there's volatility here. But the vast majority of the position is a stablecoin position, and the IPOR acts as a boost, which pretty much doubles your stablecoin. I think it's 61% with about a $25,000 stablecoin position, $5,000 worth of IPOR, and that turns 37% APR on stables into like 61%. So 61% on stables. Maybe you could go to Bunny. You could go to Bunny and you could finagle that as well. The problem with Bunny is you need significantly more Bunny in order to achieve that kind of outperformance. We could take a look and do that calculation real quick. DAI USDC. Let's say, nope, 20, 6,000, 6,500. So there's our 25,000. Oh shit, 6,500. Sorry, I'm going to show you the calculation, which I would do. 172.8 LP units. You would need 172.8, and oh, wow, 25 grand, 3. Okay, so 25 grand, 3x boost with the bunny that I have is 14 times 3. 28, 30, 40 and change percent APR. So, and my bunny's relatively a decent sized position. So I need significantly more money to get the same amount of stablecoin returns that I'm getting on IPOR. So the IPOR is an outperforming stablecoin position. It's actually 10 times more efficient at at the boost level as compared to this. So that is what I was thinking about this morning. Just giving you guys some insight into what's going on in my mind. Um, oh, CG, McMahon, that's what you meant. Capital gains. IPOR, Lit, TAP. I wouldn't think of really any of them as capital gains. I just actually mentioned FPIS, potential capital gains, considering uh, the amount of returns that Convex is incentivizing, $158,000 worth of TVL. You can see this get diluted relatively quickly. If you go over to VEF FPIS, it's producing 25% to 100% depending on duration. This is one of the few protocols that offers duration, which is quite interesting. Um, so it's quite productive if they are producing the revenue from their balance sheet. And that balance sheet, that revenue, that cash flow is surfaced here. And Convex is in turn capturing that and putting it on its balance sheet. And it is paying for that purchase, that acquisition of FPIS to Rapid and CVX FPIS. So they're purchasing collateral to put on their balance sheet because they want to build a collateral base of FPIS, which is very interesting. So I don't know about capital gains in that regard. I wouldn't do either of those with regard to capital gains. I don't think IPOR is going to be very capital gainsy. Lit may be. Lit may be a good capital gains from. You need to look for lit hidden hand once they start recycling. So they're not really recycling anything yet, but there's a lot of capital. So there's a lot of LP revenue, and there's a lot of OLIT sales. So there's a lot of potential incentive, especially partners and all the rentals, and that's the requirement for a currency recycling system. Third-party capital needs to finance the disruption of circulating supply. Otherwise, what the hell am I going to lock VE lit for? Unless someone's going to pay me. It's what we see time and time again. It's exactly why we see Velodrome doing what it's doing, and it's exactly why we see Solid significantly underperforming, because there's no third party financing that incentivizes the purchase of Solid to disrupt its circulating supply. This will not go up unless the vote rentals significantly increase with regard to the amount of capital that third parties are providing to finance rentals. Volatile as all hell. Jesus Christ, 24 cents to 15 cents. A blow off top in regards. Absolutely wild. There's ridiculous. But people, someone unloaded a clip. Look at all the buys. Someone unloaded a fat clip. Some kid shit in the pool on this one. They got good vote rentals. Whether their tokenomics, separate and apart. I don't want to dig too much into that for now. What else we got? What else we got? Last couple of questions before my brain shuts down for the day. Um, one more bank liquidation, then up only. Hallucian. No, we're not on the verge of up only. You're on the verge of just them barely trying to keep the system from imploding in a deflationary event of sorts. Sit back, relax, watch the data. There's nothing you could do. See if you could find discounts. Most of you are veterans. You've been around for a long time. So you have assets from 2020, 21, and 22. So you just sit on them. That's what Wentz, Wentz, Raul talks about it nicely. If you put Raul into like Jeff Snyder's context, it's quite interesting. Why do I say that? They're not printing currency. QE doesn't print money. So it's the perception. And that's exactly what Jeff would say. It's the perception of printing money. So Raul says, and it's the case, there's a correlation between S&P and then a multiple on NASDAQ and then a bigger multiple on the crypto markets as compared to the Fed balance sheet. That's all psychological, but the correlation exists. It's both because they're not printing money. To print money, obviously you got to first digest what the fuck money is. But the vast majority of what people use as money is bank liabilities, is bank money. And there's much less of it. So the printing of money is done by people. When people go to a bank and say, "Can I borrow money?" That's printing money. That's the overwhelming majority of money that's out there is me going to a bank and saying, "I want to borrow money." That's the majority of money. There's other types of money, but that's the majority of money. And there's so much less of that kind of money as compared to 2008. And that's the big observation that Jeff has, and I appreciate more and more at this point. So the Fed, with their balance sheet, distorts the perception of money, induces behavioral change. So we could say it's the not printing of money, but doesn't matter. As long as it's the perception, that's what counts. So, in fact, the money printer go burr meme is completely wrong. It's the perception of money printer go burr meme. But doesn't matter if they turn on QE significantly, which they didn't do this past week with the BTFP program, yet we saw the balance sheet blow out $300 billion to the upside. Who gives a fuck whether it's QE or the BTFP? Their balance sheet blew out $300 billion to the upside. The perception induces the behavioral change. Humans respond to perception. They respond to incentive. Incentive. That's the big realization. Nas Boyer, a pleasure. Missed a couple. Anand, what are your thoughts on Mim Abra? I hope they do well. They built a heck of a protocol. They've been through complex things, been through a lot of controversy. I hope they do well. I think that suffice it to say that's where I'll stand on it. I don't want exposure to it currently because I want my portfolio to say a different story. I want to be able to go out to the pool with a cigar and a whiskey tonight and not have to worry about volatility. Nasboyer, I remember you from back in the day when you worked with Digibyte. Digibyte was a different story. It's all part of the same picture, and there's plenty of things to talk about with regard to Digibyte. It would be a heck of a conversation to fold it into the story of money and incentive systems and decentralization and data storage, and it fits in. But we're not going to digress too much right now. Zeno Solidly Labs also whitelisted a pair that only they own and are directed 30% of emissions. You got to be fucking kidding me. And to top it all off, there's also private vested interests that own a good portion. Yeah, yeah, non-starter for me. No interest in exposure to it. What are your thoughts on ModeFi? No idea what it is, my friend. I don't know. It's my focus on. You got to understand money, and you'll come to rewatch this video 10 times. This was a goddamn good stream, and I'm just gonna keep going down the rabbit hole to help you guys understand the big thoughts that the intimidating presentation that Jeff Snyder offers. Um, I wonder how he would respond to that. It'd be an interesting conversation. I think a lot of folks are intimidated by his very sophisticated understanding of the system. And everyone tells a story. He's a storyteller. We're all storytellers. I'm telling you a story right now, and everyone tells it a little different. And and man, that shit is so meaningful. His story is remarkable. I find, everyone tells a different story in different ways, and Raul's story is just wonderful. Jeff's story is up there. I find a lot of folks very interesting. I like hearing many folks speak, but there's a difference between like education, knowledge, and information versus a storyteller. Frankly, I think Lynn's up there. Brent Johnson portrays a good story, a thesis, a narrative which gets tested from a hindsight perspective in 10, 20, 30 years. Anyway, stories. And obviously Luke. Luke's a good guy. Government deficits also print money. No, they don't. Government deficits borrow money from the general public. When you when you have a deficit spending, I, the government, say, hey, general public, will you invest $100 billion in these bonds? Will you buy these bonds? So the general public or corporations are giving me $100 billion. Here you go, bonds. And now the government distributes that money that it collected. Deficit spending is the epitome of not printing. Deficit spending is centralized redistribution. The selling of bonds is a socialist concept in many regards, where a central authority is raising money and redistributing it in a social manner according to social desires. I raise money and I'm going to pay for people's health care all over the place. You know, it is definitely not printing money. Um, does it mean losses absorbed by central bank? Unknown. That's a complicated statement. Are you still following red? I still have my dark nose. We'll see what happens. Unlimited losses at the central bank. Well, they can handle anything. It's not like they're going bankrupt. The complexity is, I see in my mind mostly the distinction between the perception that they have a capacity to control the system and what they actually can do. So there's a big divide, a big gap between shit they actually could control and the perception that people think they control. So the perception has a greater impact, a much greater impact on the system than the things they actually can control. As I said, the Fed balance sheet it doesn't really do anything, but it's perceived to such a great degree to affect the system that it has a 97% correlation to the S&P, as Rowell says. That is extraordinary. That is how much psychological effect the Fed has on the people, the public, the market, period. So that's meaningful. And it's meaningful to understand the distinction between the perception of control and actual control. We've never, have we seen money printing? We've seen Steve Mnuchin hold up paper dollars. Money printing literally is the Treasury turning on a printing press and coming outside with pallets of dollars and then putting them on FedEx trucks and putting them in a FedEx package and the FedEx package going into your mailbox. That's money printing. Money printing would be the mint the coin thing. If the TGA was populated by a coin, $1 trillion coin, that would be money printing. Money printing requires the TGA to go up, sourced by policy of the Treasury. Treasury wants to create currency units and their account goes up. That's money. We didn't see that. We didn't even see that with the fucking all the bailouts in 2020. We saw deficit spending. None of that doesn't do anything I just said. There's no paper dollars distributed by FedEx packages. They sent checks. Where did the checks come from? The checks didn't come from they don't come from money printing. Mint the coin is the closest we'll get to digital money printing. So it's very important to understand these things. And because then it gives you a glimpse to understand who's in control, what's in control, and you can see that things outside of the Fed doesn't have control over a lot of things. And that could highlight risk that you should probably know about. Like if some shit's going to happen and the Fed can't control it, it could influence a choice that you make. So it's the subtleties. I appreciate the subtleties. Everyone should want to try and appreciate the subtleties. Um, Critical Mass is in the house, a pleasure. Hallucian, damn, you have a nice bag of lit. What was your entry? Oh, it's nice. It's a little lit. VE lit. Lit. I think it was 7.9 cents, maybe around 8 cents after slippage, give or take, something like that. James, smash those likes. 44 people in the stream, 21 likes. I appreciate all of you. I'm going to wrap it up for today. I think it's about time for my brain to shut down, and maybe I'll play on Twitter and I'll see what the hell's going on with this crazy financial system. Thank you all for joining me. Monday, March 20th, 12:44 p.m. Tell everyone to subscribe because if they don't listen, I can't help people do a little bit better. You know the deal. After party on Discord for the most rational community in the entire crypto space.